March 2nd, 2026. Welcome to Metal Market Insight. Right now, the silver market is flashing warning signals that could reshape global trading. Shanghai is trading at a $11.63 premium over US COMEX prices. COMEX inventories have crashed to just 86 million ounces. And escalating Iran-US tensions are pushing investors into safe haven metals. Some are calling it a meltdown. Others see a structural shift in the global silver market. Today, we'll break down exactly what's happening, why it matters to traders and investors, and what to watch in the coming weeks. If silver is the quiet metal, then this week it just screamed. On Monday morning, traders woke up to a shock number flashing across their screens, a Shanghai premium of $11.63 over global spot. At the same time, Iran war alerts were lighting up news feeds, oil was spiking, and suddenly, COMEX data showed a jaw-dropping 86 million ounces moving in ways that felt anything but normal. This is not noise. This is pressure building in real time. And if you own silver, follow markets, or care about where the global economy is heading, you need to understand what just happened. Before we go deeper, if you follow precious metals, macro shifts, and real-time data like this, make sure you subscribe to Metal Media Insight right now so you don't miss the next update, because these moves are happening fast, and the window to react doesn't stay open for long. Let's slow this down and unpack what it actually means for a US audience watching from New York, Texas, California, or anywhere in between. Shanghai trading at an $11.63 premium over global spot isn't just a random price difference. That kind of premium signals tight physical supply inside China. It means buyers there are willing to pay significantly more than the international benchmark to secure real metal. When one of the largest silver-consuming nations in the world pays that much over spot, it sends a message. Physical demand is strong, and available supply locally is tight. And when local supply tightens in a major hub, global supply chains feel it. Now layer in geopolitical tension. Iran war alerts are not just headlines. They directly influence commodity flows. The Middle East is central to global energy markets. When conflict risk rises, oil spikes. When oil spikes, inflation expectations heat up. And when inflation expectations rise, investors look for hedges. Historically, gold and silver have been part of that conversation. In the United States, where inflation has already stressed households over the last few years, any new shock to energy prices can quickly shift sentiment from stable to brace for impact. Silver sits right at the crossroads of industrial demand and monetary hedge. It reacts to both growth fears and inflation fears. The dual personality makes it extremely sensitive during war scares. Now, let's talk about the COMEX number, 86 million ounces. For context, the COMEX, operated by CME Group in the United States, is one of the primary futures exchanges for silver pricing. It's where paper contracts trade in enormous volumes. When we see 86 million ounces connected to inventory movements, contract deliveries, or positioning shifts, it's not small. That figure represents a massive portion of available registered silver in the system. If registered inventories drop sharply, it means there's less immediately deliverable metal backing futures contracts. And when deliverable supply tightens, while physical premiums rise overseas, the market tension increases. Think of it like this. You have strong physical demand in Asia, pushing premiums higher. You have geopolitical risk driving safe haven interest. And you have significant movement inside the main US pricing mechanism. Those three forces don't often align this clearly. When they do, volatility usually follows. For American investors, the key question becomes simple. Is this a temporary spike, or is this the early stage of a structural shift? That's where it gets interesting. Silver isn't just a monetary metal. It's heavily used in solar panels, electric vehicles, electronics, and advanced manufacturing. The United States has been investing aggressively in reshoring supply chains and boosting domestic clean energy production. That means structural industrial demand for silver remains strong regardless of short-term war headlines. If physical supply tightens while long-term industrial demand stays elevated, price floors can rise over time. Now add in investor psychology. Over the past few years, many retail investors in America shifted towards stocks, AI names, and high-growth tech. Silver and gold often take a back seat during strong equity rallies, but markets rotate. When uncertainty rises, capital flows can change direction quickly. If Iran tensions escalate further, or if energy markets remain unstable, portfolio managers may rebalance toward hard assets. That doesn't guarantee a straight lineup, but it increases the probability of stronger bids on dips. What makes this moment different is the global disconnect signal. An $11.63 premium in Shanghai suggests localized scarcity. If that scarcity spreads or persists, arbitrage traders attempt to move metal from lower-priced regions to higher-priced ones. But moving physical silver isn't instant. It involves logistics, insurance, shipping, and regulatory processes. During geopolitical tension, those frictions increase. That means premiums can remain elevated longer than expected. Let's circle back to the 86 million ounces figure. In futures markets, most contracts are settled in cash before delivery. Only a small percentage typically stands for physical delivery. But when open interest remains high and inventories fall, traders start watching the coverage ratio. How many paper ounces exist per physical ounce available? If that ratio widens significantly, confidence can be tested. Markets run on confidence. As long as participants believe contracts can be honored smoothly, stability holds. But if doubts emerge, volatility expands. For US viewers, here's what really matters. Silver often moves faster than gold in percentage terms. When it breaks, it can run hard. But it can also retrace sharply. That volatility is both opportunity and risk. If you're a long-term stacker holding physical metal, this environment validates why you diversify outside pure paper assets. If you're a trader, it means position sizing and risk management are critical. No headline-driven market should be chased blindly. There's another layer most people ignore: the dollar. The US dollar remains the global reserve currency. During geopolitical crises, capital often flows into the dollar for safety. A stronger dollar can pressure commodities priced in dollars, including silver. So you have competing forces: safe haven demand for metals versus safe haven demand for the dollar. Watching the dollar index alongside silver becomes crucial. If silver rises despite a strong dollar, that signals underlying strength. Now I want to hear from you. Do you think this Shanghai premium is a temporary spike or the start of a larger global supply squeeze? Drop your opinion in the comments below, because this community's insight matters, and I read what you write. If you know someone watching energy markets or holding precious metals, share this update with them right now. These are the moments when information spreads value. Back to the Iran situation. Even rumors can shift markets. If tensions cool quickly, some of this risk's premium may fade. But if escalation continues, whether through shipping disruptions, sanctions, or regional instability, commodities remain sensitive. Silver doesn't exist in isolation. It sits inside a complex web of industrial demand, monetary psychology, and geopolitical risk. The number 86 million ounces keeps echoing because scale matters. When you compare that to average daily global mine production, it represents significant supply, and global mining doesn't ramp up overnight. It takes years to explore, permit, finance, and build new mines. That slow response time means supply elasticity is limited in the short run. Demand shocks hit harder when supply can't flex quickly. American investors also need to consider the broader macro environment. US debt levels remain high. Interest rates, though elevated compared to a few years ago, still sit below long-term inflation-adjusted historical extremes. If geopolitical stress pushes inflation expectations higher again, the Federal Reserve could face difficult decisions. Higher rates can cool economic growth, but persistent inflation can erode purchasing power. In that balancing act, tangible assets often regain attention. At Metal Media Insight, the goal isn't hype, it's clarity. Data, premiums, inventory movements, geopolitical triggers. When you line them up, you start to see patterns instead of noise. Monday's update wasn't just a price tick, it was a signal flare from multiple corners of the global silver market at the same time. Here's the big question that keeps serious investors up at night. What happens if physical demand continues to outpace available registered supply on major exchanges? Historically, markets adjust through price. Higher prices incentivize selling and production, but that process can be volatile and emotional. Silver has a history of explosive moves when momentum builds. We've seen in past cycles that once retail interest re-enters the space, momentum can accelerate quickly. Social media, financial news, and word of mouth amplify trends. But remember, volatility cuts both ways. Smart participants stay disciplined. So where do we stand right now? We have elevated geopolitical tension tied to Iran, a sharp premium in Shanghai signaling physical tightness, and substantial movements inside the primary US futures market. None of these alone guarantees a breakout. Together, they create a high alert environment. If you've stayed with me this far, you understand this isn't about fear. It's about awareness. Markets reward preparation more than reaction. Keep watching inventory data. Watch premiums across regions. Monitor energy prices. Track the dollar. These puzzle pieces tell the story before headlines catch up. And here's my final thought for you. Silver has always been underestimated because it sits in gold's shadow. But during periods of stress and transition, it often reminds the market that it's both an industrial backbone and a monetary alternative. If this is the early stage of a tightening cycle, the next few weeks could be critical. Stay informed, stay calm, and stay strategic. If this breakdown helped you see the bigger picture, share it with someone who follows markets. And make sure you're subscribed to Metal Media Insights so you don't miss the next real-time update. The story isn't over. In fact, it may just be beginning.